Alright everyone, Cowboy Trades here, welcome back to the channel for another update. So according to these smart money charts, the bear market in the S&P 500 is not yet over. All of these charts that we're going to be discussing today have not previously been discussed on the channel, and most of the charts that we'll be looking at in this video require the access of a Bloomberg terminal. So these are charts that you will not likely find from other S&P 500 YouTubers. If you're a veteran, you know that we've previously looked at smart money metrics such as the insider transaction ratio and detailed when these corporate insiders have been selling in the equity markets. Here is the opposing side of this chart. This is the retail money market funds. Now, if you don't know what money market funds are, I will leave a link to Investopedia down below. Basically, a money market fund is basically just a mutual fund which people can invest in. These funds typically hold stocks, paper, gold, and also high quality short-term debt instruments such as cash and cash equivalents. And there are mainly two types of money market funds. There are money market funds for accredited investors. Accredited investors are investors that have more than $1 million and have access to money market funds that retail investors don't have access to. And then we have the other side of the coin, which is the retail money market funds. This is where the average Joe can go in and invest $25 a month or something into a retail money market fund. Now, with these retail money market funds, we can see the total summation of all of the billions of dollars that are currently in these money market funds. Now, keeping things very, very simple, if we look at the chart, you can see a massive spike up into the 2000 financial crisis. You can see a massive spike up and a top for both of these coming into the 2008 financial crisis. Now, do I really need to detail what happened in these scenarios? Of course, if you're a veteran of the channel, you'll know exactly what happened. If you're an investor in the S&P 500, you're probably almost guaranteed to know what happened. So I won't delve too deep into this. 2000 financial crisis, 2007 financial crisis, proceeded with recession. You could also see a massive spike from 2017 running up into 2018, running up into 2019 before topping out in early 2020. What happened in, this massive run up to the upside? Recession. What is happening right now with the retail money market funds? This is hitting an all-time high, and not only is this at an all-time high, this is more than 35% higher than it was in 2008. Now, you could adjust this for inflation if you want. I don't particularly think it's necessary. Obviously, we have had a lot of inflation since 2008, but the general picture in this is that retail money is the most invested than they've ever been. Right now, where the S&P 500 is trading around about 4,150, retail traders are extremely interested in this market, and as we can see with these peaks before, this has never fared well for the economy. So as we've been discussing on the channel, smart money's not interested. They've been selling every single rally that the S&P 500 has had in the past year or two. And the other side of that coin is that retail money is becoming more and more invested. So there we go. I just wanted to quickly touch on the smart money and retail money side of the argument and what is happening with the S&P 500 investments right now. Let's now move on to a couple of charts that I picked today from my Bloomberg terminal. Like I said at the start of the video, Bloomberg terminals require a yearly membership and they're pretty much inaccessible to retail traders. So these charts that we're going to be diving through are not likely going to turn up in the feed of your favorite S&P 500 YouTubers. With that said, let's dive right into this. I want to start off on this chart looking at the market breadth. Now, what the market breadth shows us is it shows us the amount of stocks in the S&P 500. Obviously, there's 500 stocks comprised of the S&P 500. This shows us the total percent of the members in the S&P 500 which are above their 200-day moving average. Now, this is shown with these orange bars over here. The S&P 500 is in white and the 200-day moving average is in yellow. Now, as you can see, the S&P 500 is above the 200-day moving average right now, but if we're looking at the total market breadth, as in the total percentage of S&P 500 members above the 200-day moving average, it's only at 49.7%, meaning that 50.3% of the stocks in the S&P 500 are below their 200-day moving average, and this S&P 500 rally is really being held up by a minority of stocks. Now, market breadth is a really interesting signal from 2019 all the way up to 2021. You can see while we were having this explosive bull run, market breadth remained above the price of the S&P 500 index. This basically showed us the economy was very healthy. The top 500 stocks in the S&P 500 almost topped out at 100%, meaning that most stocks throughout the entire rally were trending above the 200-day moving average, and in general, everything in the S&P 500 was looking very, very healthy. And then you can see this pivotal moment that came round about mid 2021, where the market breadth started to break beneath the 200-day moving average. It started to break underneath the S&P 500, and round about this region that the S&P 500 topped out at, the market breadth was showing us that the S&P 500 as a whole was very, very weak, and the S&P 500 continued to push up based on a minority of stocks which were outperforming the rest of the S&P 500. Since this bear market has ensued, which was caused by the market breadth, you can see the market breadth has continued to diminish. And as we said, only 49.7% of the stocks in the S&P 500 are actually currently above their 200-day moving average. So right now, the S&P 500 index has quite recently double topped, as you can see over on this chart here, but the market breadth has made a lower high. This is pretty much a bearish divergence, and this really just shows us that, the majority of the S&P 500 is weak right now. Of course, you do have some strong stocks in the S&P 500 like Apple, which are very, very close to making new all-time highs. They're up 37% year to date as compared to the S&P 500, which is up about 7.6% year to date. Now, the next chart that I want to talk about is the P to E ratio, also known as the price of the S&P 500 divided by the earnings of the S&P 500. All I really want to highlight in this chart is that there's been little growth in 2023. If we come back to January, we've experienced a 1.4% increase in the year-to-date P to E growth. And if we go back 6 months ago to where we were in November, we've actually experienced zero growth in the price to earnings ratio. So what I really highlighted over here, and I shared over on Twitter, is that the P to E ratio increasing 1.4% year to date doesn't really justify an S&P 500 valuation at 4,100, anywhere near 4,000. And of course, P to E growth being up 1.4%, but the S&P 500 being up 7.6% is kind of degenerative, and really just highlights right now that this is not a market driven by strength in the economy. It's not a market driven by smart money investing. We don't have strong S&P 500 breadth right now. This is really a retail driven market for the most part. Also, this chart here is really just an interesting idea. So, don't take this one super seriously compared to the other charts. This is just something interesting that I found that you can do over on Bloomberg Terminal. So in this post, I talked about, what should the S&P 500 be valued at? It's obviously quite subjective, but an interesting chart that I managed to come across over on Bloomberg happens when you get the summation of the S&P 500 and you divide it by the estimate earnings of the S&P 500. So, obviously we've got the P to E ratio. Do bear in mind we're in earnings season right now, and we haven't fully wrapped up earnings season. So we have some estimate earnings which do come into account when we're looking at the estimate earnings rather than the P to E right now. But this is a very similar idea to the price to earnings ratio. We're just getting the price and dividing it by the total estimate earnings of the S&P 500. And this gives us a subjective valuation of the SPX. Now, there's a few things I want to point out in this chart. Some are common sense and some are quite interesting. So let's talk about it. Now you can see from mid-2017 all the way up until the 2019 mini financial crisis pandemic scare that we had, that the adjusted price of the S&P 500 divided by its earnings tracked absolutely beautifully. These were absolutely in tangent with each other with close to 100% correlation. We had that pandemic scare, they started to nuke to the downside, and of course they started rising up at the same time, but what you saw is the adjusted price divided by the estimate earnings went on a much quicker rally to the upside than the actual price. And this, like I said, is a very similar idea to the price to earnings ratio, and also something very similar to when we're looking at the market breadth. Like we can see, the market breadth went on a faster rally than the S&P 500 did. And what happened was the S&P 500 eventually managed to catch up to the market breadth where they topped out together. So of course, bull runs are supported by strong P to E ratios, strong market breadth, and bear markets are accentuated by having poor P to E ratios and having poor market breadth. So if we come back over to this chart, so what's interesting about this is you can see if we get the price of the S&P 500 and divide it by the earnings, earnings started to take a massive climb up before the S&P 500 did. They obviously climbed up together. Earnings outperformed the S&P 500. So what happened was we had very strong earnings, and the S&P 500 eventually caught up. So You might look at this and say, oh, this is a divergence, oh, this is a divergence. If you don't understand the fundamentals of this, yeah, it would make sense. But of course, fundamentally, we know when market breadth is strong and when P to E ratios are strong, these are good signs for the economy, and the S&P 500 eventually caught up to its price divided by its estimate earnings. So right now, we see the opposite side of the coin. We see the S&P 500 earnings being pretty poor, and when we're looking at the price divided by the estimate earnings, they're very, very weak right now, and this could suggest an S&P 500 valuation around about the $3,150 mark. So previously, when the P to E took a massive skyrocket to the upside, the S&P 500 caught up. Like I said, this is more of just a fun idea, but it would be very interesting to see if this model holds true and the S&P 500 actually catches up to its price divided by its earnings ratio. So for today, my friends, that's all I've got. Like I said, just wanted to share some of these charts with you. I'm still currently learning some of the functions on the Bloomberg terminal. And also, if you've ever seen a Bloomberg terminal, you know that they've got very specific keyboards with multiple different functions on the keyboards that you don't have on regular keyboards, such as, you know, currency and forex buttons, things that just make navigating the Bloomberg terminal a little bit easier to use. So I've actually got a separate PC set up with my Bloomberg terminal. If you're interested to see more economic data from my Bloomberg terminal, let me know in the comment section down below. And when I get a little bit quicker at navigating through the Bloomberg terminal, I will potentially set up a new microphone with my other PC, and we can run through some of this data together if that is something that you're interested in. But for today, my friends, that's all I've got. These two charts here are the main focuses of the video. Right now, we have retail traders very, very interested in the market, while smart money is not interested in the market. And we have very, very weak market breadth, which signals that the S&P 500 is extremely overvalued right now. So like I said, for today, my friends, that's all I've got. If you do enjoy my content, let me know down below by leaving a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Follow me over on Twitter at 618_cowboy for more of these economic data threads, interesting charts, memes, up-to-date posts on what is happening with the CPI, other economic data, all of that good stuff. But I'll leave it here. It's been your boy Cowboy Trades. I'm out. Peace.